Welcome to this latest update on Casterbridge managed portfolios. If we start by looking back at 2023, most equity markets were up, not so much because of strong economy and buoyant earnings, but more in relief that we didn't enter a deep recession and on the hope that inflation would start falling and so central banks would be able to cut interest rates. And we were relatively cautious given the uncertainty about the impacts of the very high rates which we'd seen and escalation in geopolitical risks, but still made respectable mid to single digit returns. And we continue to manage portfolios with below average volatility, as this can be just as important for clients as the overall returns themselves, particularly when there is so much uncertainty around. And looking ahead into 2024, we can be optimistic on the back of strong employment and wages and the resilience of the economy and consumer. And for example, here in the UK, we will see inflation falling over the coming months, and quite significant falls in energy prices, over the next 2 quarters. I think the question is, how much of this of the good news is already discounted into markets. And we also have to, navigate the numerous elections around the world this year, and the escalation in geopolitical tension, which remains our biggest concern. And it's these growing divisions which mean that we'll continue to see reversal of the globalization, which has been so beneficial for global trade over the last 20 to 30 years. And this is why, we continue to assess, how do we best navigate, these types of headwinds. And so while we may remain somewhat cautious from a top-down or macro perspective, we remain optimistic that from a bottom-up perspective, we can continue to find experienced and nimble managers who can navigate successfully the economic and political twists and turns which we expect to see. So we're making a couple of changes to portfolios this month. Within bonds, we remain underweight as we continue to see risks in this market, but have sold our short-dated UK government bond fund to buy a longer-dated passive gilt fund. And this should benefit from greater capital appreciation as interest rates are cut over the coming months. And then within equities, we're selling our dedicated commodities fund. We still like the sector and are maintaining an overweight position, but this sale enables us to introduce 2 new funds for most portfolios. And the first is a UK small cap fund, which looks cheap and a very interesting space over the next year or so. And second, we're buying into an AI fund. And this space has huge potential and an area where we expect to continue to build exposure in different ways over time. And this fund is much broader than like a pure tech fund. Only about 50% is invested in technology companies themselves, and the balance is invested in other areas such as industrials and healthcare. So I think just to sum up, we're still positive on the opportunities in equities, but feel it's prudent just to be careful in how much risk we take at present, just given the uncertainty around inflation, the path of interest rates, numerous elections this year, and the ongoing geopolitical risk. So I hope this was a useful update. That's all from me for now. Thank you.